protecting Main Street from Wall Street. It's time for Money Unleashed with Eric Johnson and Kyle Allyn.
You have to have a plan where you know if the market's going to go up, what happens next. And you also have to have a plan where if it doesn't go the way you think, you know what you're going to do.
It's time to put you back in control of your money.
I'm not trying to predict the weather, which is kind of what we're talking about, right? It's predicting the stock market. I'm trying to build a better boat.
This is Money Unleashed with Eric Johnson and Kyle Allyn.
This is the Money Unleashed podcast powered by Hoffman Financial Group. I'm Eric Johnson. Alongside me is Kyle Allyn. We got new episodes coming your way every Friday, so make sure you're subscribed to Money Unleashed wherever you get your podcasts. What we're going to be talking about, why it's so important to have an advisor, because essentially what you and I do on a day-to-day basis is we're coaching people through all the ups and downs of the market, and we've been doing a lot of coaching for the past couple of weeks, naturally, because we've come off the highs and we've had a little bit of a dip, right? So let's hop into what's been happening and the volatility of stocks that have historically happened, right? So we've got a chart from Joe Terranova on CNBC, and it's talking about momentum sell-offs. And obviously nobody likes it when it goes down, right? However, there have been many instances in the past where we have had an 8% dip, a 10% dip. These are past 2 years, by the way, and the market's still gone up, 20%. You could still have a 10% gain. This is not body bags for the year, right, Kyle?
Yeah, I think this is so fascinating to look at because most clients probably wouldn't look back at the good years and think that there was a big pullback. So even in some of these average years, if you look at, say, 2012, you can see that the market went down 10%, but it finished up 13% for the year. If you look at 2019, which was known as a really, really good year in the stock market, we were up almost 30%. There was a 7% sell-off. So one of the things to remember is there's an average inter-year drawdown of 14%, and the market has a 95% chance of a 10% drawdown in a year. And I'm going to say that again because I reiterate this to clients a lot. The average intra-year drawdown is 14%.
Yep.
And the ability to go down 10 is a 95% chance each year. So if you know that, then you come into the process with the awareness that volatility, risk, drama is just a part of it. I say to clients often, water is wet.
It is wet.
Yeah, if you get in the pool and you go, I can't figure out why I'm wet, well, you got in the swimming pool. So one of the things to remember is when you get in this pool, you are going to get wet. And when you stop and say that to yourself, then you're able to operate with some logic, right? So once you understand that the market is volatile and you understand that it can go down 10% at any given time, then you're able to kind of come back into what you're able to tolerate. And I think this is the number one reason you need a financial advisor. If you felt what just happened in any way, and it registered emotion, you made yourself uncomfortable, this is why you need another person helping you with your assets. Because as Peter Lynch said in the 80s, to be successful in stocks is to not be
get scared out of them. Yeah, and that's one of my favorite quotes. Warren Buffett, when you and I, we utilize a lot of his information as well, too. And, Warren would say something very similar. It's like, if you're not ready at any given moment to be down 30%, don't be in the stock market, right? So this isn't just like a slot machine that guarantees you a win every single time. You have to play the ups and the downs, and you have to have a plan that's actually going to get you through both of it, right? Like, you can't just live by the sword, not die by the sword. Like, if you're going to be in a portfolio that's all in equities, then yeah, you're going to deal with the ups and the downs of the stock market. Now, I think it's actually really interesting, though, the chart that we're looking at, because it shows you all the other times throughout, since 1990, the intraday drawdowns. And it doesn't mean just because it happens at the beginning of the year, this is a really bad thing. It just means, hey, this is a reset, which very frankly, we needed. When we were up, 20+% 2 years in a row, I got news for everybody. That's not sustainable. So the fact that we are having a good reset is good because bulls run out of juice and bears run out of juice. That means they got, less things to sell, less things to buy. And it's a good thing for the stock market to take a breather from time to time so it can break through to more all-time highs. Because if we don't, Kyle, it's a guarantee 30% drop down, and nobody wants to see that. So if you can deal with the 10 and have a plan that's going to properly get you around that 10 and take advantage of that 10, because you know that if a 10% drop pops down, we have ways to add more to our stock positions or get more defensive if we need to. That's really important, right?
And you made a great point. So on the other side, if you guys could see the chart that we're looking at here, ultimately the market doesn't go down and stay down. So One of the things that you can see here is in years like 2008 when the market was really bad, it went all the way down 49%, but by the end of the year it was only down 38%. So when you feel that energy, when you see the market down 10, how do you know that you're not literally selling at the bottom?
That's true. And we discussed panic selling last show, right? It's a big mistake because if you get out and you've got no plan, and I want to kind of clear this up a little bit for people that are out there. When we're saying panic selling, that means selling everything, getting out of the market and just sitting in cash, not making appropriate changes for what's going to come next. So like, it's actually quite a good time if you are going to be making any changes to your portfolio, if it's been underperforming, if you had the feeling it's been underperforming, for the past couple of years, now's the best time actually to actually make a transition and a change. Because if it's been underperforming for the past 2 years, it's not going to bounce back up properly. So if you make the proper changes, you can actually see a really great result for making those changes. So I just want to make that clear, number one. But if you're going to be panic selling, right, it's really a bad thing. And and I'll say it again because we said it last show, is let's say the market goes down 10% and you sell, right? Well, I think the market's finding a bottom right now. It did last Friday. It did this Monday. And, I think it's finding a little bit of a bottom. And what happens is it touches the bottom, it pops back up, it tests it again, and it starts, moving in the direction back where we like, which is up and to the right. But if you get it into cash, and let's say it goes down 10% and you're out, and you wait 2 months and it comes right back and it's higher than it was when you got out, now you just lost twice because you're buying those equities or whatever investment vehicle is at a premium, right? And you just lost twice. You guaranteed a loss on the way out, and now you're buying higher than you did when you got out in the first place. So that's why panic selling is such a big thing. But I'd like to remind everybody that, sometimes everyone wants to buy and sell. A lot of people forget that holding sometimes makes more money than both of those combined, right? And there's a reason why people hold, especially if you've got positions in your portfolio that you like and trust. Like no one's going to be selling. Like Warren Buffett doesn't sell all of his Apple.
Yeah, and
right?
And I think it's the all part that gets everybody. I tell clients sometimes, I'm always doing something. I'm never doing everything.
Right.
Meaning, we're trimming on the way up. So as the stock market was rising for the last 2 years, we were trimming positions and putting those into our pocket. It didn't mean that I didn't believe in them anymore. I just felt that they were getting heavier and heavier and heavier. So we're trimming a little bit out of the position to put that into a safe place. The good news is when we move to a safe place, we have the ability to still grow. Maybe not as much as, say, NVIDIA, but we do have the ability to grow. On the flip side, now that the market's starting to sell off, I'm getting ready to start buying things. So those positions that got put in our pockets, I want to move them back into market position. I mean, you have to have these disciplines. You have to have these processes in place, because if not, then what you do is you just panic and sell everything or panic and buy everything.
Well, and it's also certain people, right? I mean, for instance, if you're in your 40s, you can just go right ahead and just wait right through this thing, because what we're dealing with as retirement planners on a day-to-day basis is the enemy of time. Time is your actual enemy. It's not administrations. It's not other countries. It's not your neighbor. Maybe it's your neighbor. I don't know. But it's really
depends on the neighbor and the neighborhood.
100%. But with all honesty, it's time, and that's the problem. And people with less time, or people that's a year away from retirement, or maybe even 2 years from retirement, and it's understandable because they might freak out a little bit because they're trying to get to a certain number before they can kind of get into an income plan. And you just need to understand that these things happen, and time doesn't care, right? The market doesn't care when you decide you want to retire. They're afraid they have to work a little bit longer, or they're afraid that they're going to have to hit the ball a little bit harder and get even more aggressive when they don't want to, and that's understandable. So that's the type of fear you're dealing with, but that's precisely why you need a coach, is to help you out with those emotions, right? Like we get hired to take the emotion out of it for people, and they also hire us to be right, like to make the right moves and to get their portfolio where it needs to be so they can't have a successful retirement.
And I want to stop you and say this, because I always tell clients this. To be right is about the disciplines, not about the future.
Correct.
We're not saying we know the future. Financial advisors do not know the future, but we know the disciplines to survive any of the scenarios.
Agreed. So how do you get one of these coaches? Let's talk about that for a second. So, I don't know how the other advisors do it, but I know how we do it. So I'm going to talk about that. And the first step is signing up for a portfolio x-ray, right? And we offer that to people at no cost, no obligation. And what does that mean? So what we do is our client services teams ask you to please deposit your statements into our completely protected website. And what we do is we develop a couple reports, which is a Morningstar report and a quantitative analysis report. And then what happens is you get linked up with an advisor, right? Could be me, could be Kyle. But we also have 8 other advisors underneath our umbrella that are also just as fantastic. And what we do is we do a deep dive into, what does retirement mean for you and what's working and not working inside of your portfolio. Then if you wish to come for another meeting, we're able to do or put together a plan that works for you and your family. And I would recommend that everybody out there, if you're having these feelings, this is something you need to do. So please give us a call. We're happy to help you with this. 404-640-5511. That's 404-640-5511. Or you can find us online at unleashyourmoney.com.
Eric Johnson and Kyle Allyn are investment advisor representatives of Brookstone Wealth Advisors, LLC, a registered investment advisor and affiliate of Brookstone Capital Management, LLC. BWA and Hoffman Financial Group are affiliated under common ownership. Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interest of our clients and to make full disclosures of any conflicts of interest. Please refer to our firm brochure, the ADV 2A, page 4, for additional information. The Hoffman Financial Group and WSB are not affiliated. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. This information should not be considered tax or legal advice. Individuals should consult with a professional specializing in the field of tax, legal, accounting, or investments regarding the applicability of this information for their situation. Any client experiences discussed during the show are unique to that client. They are not meant to imply or suggest you will experience the same results. Past performance is not a guarantee of future results. Investments will fluctuate and when redeemed may be worth more or less than when originally invested. Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone. Index or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract. Please refer to our firm brochure, the ADV 2A Item 4, for additional information. Hoffman Financial Group is not affiliated with or endorsed by the Social Security Administration or any other government agency. Insurance licensed in Georgia, number 163546.